Welcome back to the Alts Podcast. I'm your host, Horacio Ruiz. We bring you industry leaders and creators to give their insights on the rapidly changing and exciting world of alternative assets. Opinions expressed on this podcast by the host and podcast guests are for informational purposes only and should not be considered investment advice. Podcast hosts and guests may maintain positions in the offerings discussed in this podcast. The intro song, Fishing for Pets, is written and composed by Alan Goldshire from his latest release, Live at the Lakeview Lounge. Thanks for joining me on the podcast today. Our guests are Brian Harstine and Andrew Hill. Andrew is a managing associate of the law firm Frost Brown Todd and one of the leading experts in blockchain and cryptocurrency law in the country. Brian is the CEO of Acquire, a company that is tokenizing securities of private equity deals. This is Brian's second time on the podcast, and we're looking forward to getting updates on Acquire. In this episode, we'll discuss the advantages and diversity of blockchain technology and legal issues in the space, among other things. Let's jump in. All right, guys. So thank you for joining the podcast today. We have Brian again. He's a return guest. Brian, welcome back.
Hey, thanks for having us.
Thanks for having me. Absolutely. Great having you guys from Acquire. And he's joined by one of the leading lawyers in terms of security tokenization, one of the leading lawyers in regards to the blockchain, Drew Hill. Thank you for being here, Drew.
Hey, thanks for having me. Appreciate it.
Brian, last time we talked, we kind of talked a little bit, we're talking about Acquire, and we're talking a little bit about, where the company was headed, some of the things that you were kind of had in the works, right? And you certainly have had some movement in that space. But I was wondering if we could first, we have Drew here for the first time, and I know Drew's been with you since you were founding the company, and I was wondering if he could kind of share his insights, kind of what he does on the legal side, because it really is kind of fascinating being a lawyer in this kind of crazy world of blockchain.
Yeah, sure. I'll just pick that up. I've been practicing with Frost Brown Todd in the blockchain and cryptocurrency practice since 2019. The practice itself dates to 2017, so kind of the peak ICO days. We've seen kind of everything under the sun in the blockchain and crypto space, multiple market cycles, and recent events tend to lead us to believe we may be entering into another fun crypto winter. So that's where I think builders like Brian and projects like Acquire really show their value, and kind of gives them an opportunity to put their heads down and build and come out the other side ready to take advantage of the next market cycle.
Yeah, I mean, you bring up a great point. Like when you have a crypto winter, or just in general a downturned economy, which is what's happening now, most people, they start to pull back a little bit. They're not is freely investing, whether it's individuals, venture firms, private equity firms, these angel investors, they still allocate a lot of money. They still realize that like building has to occur, companies have to grow. But at the same time, when they do pull that back a little bit, 15, 20%, you see companies like ours shift our focus from, just purely raising money left and right, so that we can increase our growth to, like Drew said, building value, focusing on the product, focusing on the user, and doing a lot of more intelligent market research on what we're doing.
How essential has Drew been, like working through this blockchain process with these laws, these regulations? It seems to me from the outside looking in, right? I'm not an industry expert from a legal standpoint. There's a lack of clarity, right? So how is the law applied to the blockchain right now, Drew?
Well, the answer is we're still using orange grows from Howey in the 1930s to apply to digital assets and security tokens and everything else. So we're working with well-worn frameworks, and I always say there's really nothing new under the sun, and it's a matter of fitting the technology into the existing frameworks until further clarity gets rolled out. So I think we're going to touch on this a little bit later, but there's certainly examples where technology gets ahead of regulation and creates some difficult challenges to overcome. I think as far as acquire is concerned, and Brian can speak more fully to this, the focus is 100% on compliant, regulatory compliant products to offer to users. And so for us as lawyers, honestly, that makes the job easy because we can identify where the bright lines are, and we make sure we don't cross them. And there isn't a gray area that needs to be treaded into.
Yeah, I mean, the products that we are focused on, they are built on blockchain technology, right? We're using it as a rail. It's no different than when we shifted from paper to Excel spreadsheets, right? It increased our efficiency and increased how much we could build and what we could build. And using blockchain is another evolution of financial markets. And it doesn't just mean cryptocurrencies or stable coins or NFTs. We are using that technology to power traditional assets and bring them to users at a scale that has previously been more costly, less efficient. And, now we can actually bring these users assets that previously they were even unable to have access to due to costs, regulation, and so on. So yeah, I mean, Drew and Frost Brown and everybody that works with us on the legal side, it's been a really crazy learning curve going up and down through, what we can do versus on a technology side versus what we are allowed to do on a regulatory side. And then marrying those two pieces into a product that can still, realize as much of the blockchain's potential as possible without crossing any sort of, regulatory lines in the sand, so to speak.
I think the thing I like about Brian's approach to the technology is that his users are technology agnostic. They don't need to know what's going on under the hood to be able to take advantage of the technology. And so sometimes I think objectively crypto and the blockchain is not intuitive to adopt, to understand, and you really have to jump in, and there are no guardrails. So, people lose a lot of money through mistakes and things like that. But, companies that are building using that technology, don't need to expose their users to it directly in order to benefit.
Yeah, you touched on something interesting. There's two types of users. You have your early adopters, and then you have the rest of the world, right? The early adopters are the ones that are building blockchain right now. They're inside of these various DeFi protocols. They're playing with NFTs, and they are the ones that are going to be very interested in what we're doing from a technical level. But then there's the other users that are sitting out there that go, look, if it's better, if it's faster, if it's cheaper, if it gets me access to something I didn't have access to before, then I'm in, right? They don't care about what's under the hood as much as the early adopters do.
It's very much the same way that, I honestly have no idea how the internet works, but I use it every day. I probably shouldn't say that as a technology lawyer, but here we are.
That's a very good point. That's a good point. You're laying out some reasons for why, what you're doing and using the blockchain would benefit anybody. Would benefit an investor, would benefit somebody that's interested in looking maybe in diversifying their portfolio. But there's always that thing, right? Like, why the blockchain? Why are you doing this? Why are you building it in a way that's not the traditional methods? And I wonder if you could talk to some more to that, right? Like why did you decide to do the blockchain? And specifically, like, if someone's seeing this crazy crypto market, this crazy situation where we have regulators, Capitol Hill talking about how they need to regulate. Do you feel like that scares away potential investors, potential users of a platform like Acquire?
On the other hand, it actually does the opposite for us in particular. The more clarity that comes around blockchain, and Drew can definitely speak to that part, the more, that it becomes regulated or regulated to a certain extent, hopefully not over-regulated, because that does tend to, limit the amount of innovation that we can have. But I think that for us in particular, because we are working in the bridge between traditional and this blockchain world, allowing that regulation to exist and be programmed into the asset itself. It allows anybody from the traditional world or the blockchain world seeking a more compliant product or a compliant vehicle that's still utilizing this technology, allows them to come to us for that solution. So we have two business lines. There's some B2B services that we are working through, and then we have our direct to consumer app, which is bringing private placement assets, and alternative type assets apart, not really on the collectible side, to direct to users. But yeah, I think that when the regulators push it, they say, hey, this has to be regulated. The whole world says, okay, well, if we're going to use this technology, we need to do it in a compliant way, in an automated compliant way. And that's literally the position, the fork that we sit at as a company.
Yeah, and I think the technology can be leveraged, to Brian's point, to reduce costs and friction in markets without people really knowing that that's the technology that's serving that role. And a perfect example is kind of low hanging fruit, like a transfer agent in a way a traditional stock is settled. And really, blockchain and tokenized securities can be self-settling. So that would potentially remove a middleman friction layer from an entire securities trading system. That simply doesn't exist right now and adds cost whether we know it or not.
Yeah, I mean, transfer agents are interesting. There's a number of entities that exist behind these markets. Let's take collectibles. This is a world that a lot of your users, play in the alternative space. You've got collectible.com and Masterworks and Rally Road and things like that. And, what powers those markets is broker dealers, ATSs, transfer agents, and a decent amount of legal frameworks, and it's built in a way to provide liquidity to assets that were previously illiquid. The only way you could get ownership of one of these things is to shell out a bunch of money. Now they're fractionalizing it, they're putting it onto a marketplace, and they're giving you the ability to own a piece of it and get the type of appreciation that you normally see with these type of artworks or cars over the long term. And they are very anti-correlated with or uncorrelated with traditional assets or markets, which is a very cool place to be. But those entities, like a transfer agent, that still exist on the back end of that market, they're already going into a fully automated system that does use the blockchain. There's several transfer agents we work with directly that basically they have to keep two databases, one on the blockchain, which then feeds that information back over the cap table, the proof and record of ownership, back over to what they would call a compliant database, which is just a regular spreadsheet, right? And that's the thing that the SEC likes to look at rather than on-chain data. But all the on-chain data is what's actually powering the settlement transactions.
I think it's important, because you're talking about building almost like a traditional business in terms of like current technology, right? Of the future, a current business platform of the future. And I think it's important to kind of be able to separate that from that kind of blockchain development from the madness, right, of say UST, from what's happening right now, where people are being liquidated 100%, losing their life savings, apparently. And I always feel like there's a public perception where it's difficult to rip the two apart, right? And a lot of our readers as well, like anything blockchain related means is associated with the headlines and kind of like the market meltdowns. Could you talk a little bit more about that? Like how they're not related at all. You're talking about two different types of uses for the blockchain.
Yeah. I mean, Drew's dealt with legal across, God knows how many levels of blockchain applications. You're looking at, like I said earlier, you have NFTs, you have stable coins, which is UST. You've got, securities tokenization, which is the compliant form that we deal with. You have cryptocurrencies, Bitcoin, and so on. And when you're talking about a stable coin, there are so many flavors of stable coins as well, meaning what makes it stable? What's the technology? What's the mechanism behind it that's making it stable? What is it backed with? Is it backed 1-to-1 US dollars to one coin, or is it backed with some other type of asset? Is it backed with gold? Is it backed with a basket of assets? And you're seeing with some of these structures that are being built and innovated on to try to create, more efficient or hypothetically more efficient stable coins, that some of those structures aren't fully built yet. They're realizing flaws, and like all developers, you have to break things to fix those flaws. And you're seeing the U.S., I guess, Senate Banking Committee, Janet Yellen, and everybody really using these flaws, and when they do occur, to say, look, guys, over here, there's issues. We have to regulate this. People are using this, and she's going to as far as to say, look, by the end of 2022, I want to see something, in stone from our regulators, specifically revolving around stablecoins. I'm fully supportive of stablecoins, but not all stablecoin is created equal, right? So just be aware of how the stablecoin's built, what's backing it, and which one to use.
Yeah, I think the general cryptocurrency token market is still feels a little bit like the wild, wild west, and so I understand the skepticism that people have, but I think it's important again to just note that the technology itself is different than a potential use case or application of that technology, and so I think it's important not to just dismiss it wholesale because of bad headlines associated with certain products or scams or otherwise, when there is very real building going on and very real real world applications that will be and are coming down the line. And I think notwithstanding the current market, whether it's traditional equity markets or crypto markets, that the trend that we've been seeing over the last 12 months is a lot more serious venture, private equity, and institutional money looking at the space and looking at people building in the space, seeing a lot of capital formation around these types of companies, and less, I think, focus on the crypto assets as an investment class, but again, putting money and weight behind builders in the space.
Yeah, I mean, that's a huge point, right? Institutional players, they used to have this phrase, right? When they were talking about Bitcoin or blockchain in general, the applications of finance, when we say tokenize the world, things like that, they would say something like, it's an if, and then it evolved after a couple years towards 2017 to now it's just a matter of when. And then now here we are in 2022, and Bitcoin earlier this year popped to 66, and now it's down all the way down to 30, but still much higher than it was in 2017. And now they are literally doing it, right? They are working with blockchain. It's inside of their business lines, not across their entire companies yet, but they are utilizing blockchain to make some of their business lines more efficient. So it's no longer if, it's no longer when, it's actually happening now at the institutional level. And I think that says everything. If they're moving that direction, if the people that are managing, $10 billion under a single, organization or more are sitting there going, how can we utilize this to improve our functions? Then, I think that it's time for everybody else to start asking those questions as well.
Yeah, you get the headlines. And as a quick example, like I know JP Morgan, right? So the employees were banned from talking Bitcoin. And this is back in the mid 2000s. All the while, they're using a blockchain in their business, like in their business line, to streamline their operations because of Bitcoin, because of what they saw with, the blockchain through Bitcoin. So then they started developing their own blockchain. Really, really curious how you do that. Brian, I wanted to get into Acquire. We talked a month and a half ago, and I wanted to talk to you about like the latest developments, what you're getting ready to launch, and take it from there.
Yeah, definitely. So we are, I think I've said this before, but we're drinking our own Kool-Aid, right? So we are, tokenizing our own equity. using technology that we are developing alongside of some of our partners. And we're offering that out to the public. So we've been busy developing and producing a lot of new materials, revamping of the prototype of the app into a beta, and bringing that to the public and allowing them to become shareholders in our company, utilizing two different forms or two different ways to become a shareholder. We're going to engage the average person through a WeFunder later this month, and then we're going to also launch a security token offering sequentially, which is specifically with our technology, and that's going to be late, probably in about 2 months. So sequentially after we close the WeFunder. So Drew's been working with us quite a bit, figuring out all the ins and outs of bringing a security token direct to consumers. We've been working with a lot of different regulatory compliant partners like our broker dealer, right? Our transfer agents, and basically, we're prepped to launch something that we think is one of the first of its kind, because we're tying it to something called an access card NFT. And it's a very interesting way to incentivize and give more value back to our shareholders. And this is not your typical NFT that's just like a Bored Ape, where it's art. We're actually using it as a card that gets linked to your account within our app, gives you discount on trading fees, gives you rights to first looks on new investments that will appear on the app in the future before the public. So these are tangible benefits that an investor or a user of our app can actually use to create value for themselves. And on top of that, this is a membership card that you can actually sell on a secondary market. One of our marketing guys pointed out that evidently if you sell it, you reduce your cost basis on the equity in our company. So thought that was kind of interesting. But yeah, it's a kind of a cool thing. It's the first of its kind in that way. And we're really excited about bringing it out to the public. And I'm happy that Drew helped us get it done in the right way. So yeah, that's what's coming up here soon. And hopefully we'll hit our beta launch and get all of our users and holders and shareholders of this NFT access to that beta launch exclusively, late this year. So,
if an investor wants to get involved, in different ways, should they get involved in the WeFunder? Should they get involved with the security token? Obviously, maybe the answer is both. But what's the difference there?
Okay, great question. Yeah, so on the WeFunder, traditionally people that may not have a digital wallet, right? They may not have digital assets that they want to engage or purchase their shares with, their equity, stake in. They're probably going to go through a WeFunder. This is just something where you log into a regular app or regular web portal run by WeFunder, who we've partnered with for this, and then they just link a bank account or credit card, and they're able to pay and purchase that equity directly through the WeFunder. We now take that cap table, and we have tokens waiting for that person, whether they want to spin up a wallet now, or if they want to wait till they download the beta app. They will have also the actual tokens waiting for them. So this is the WeFunder is just a fiat currency, a US dollar way of engaging with the offering. The STO launching a little bit later, this is targeted towards more DeFi people that understand Ethereum or stablecoins or other methods to move around that decentralized finance ecosystem. And they may already be holding those. They may not want to sell it in order to buy their equity. So we've created a security token gate, a compliant security token gate that allows those users to connect their wallets, go through a KYC AML system, and then that gives them access, as long as they pass, into this gate that allows them to, get their shares. They can transfer half an Ethereum, or they can transfer some USDC, which is one that I actually like on the stablecoin side. And in exchange, directly through that smart contract, they get those tokens direct to the wallet. Now, either user will have those tokens waiting for them in their acquire account, whether you go fiat currency or if you're in the DeFi side, and you're able to use these shares, these smart shares that we call them internally, as a means to claim your NFT access card.
Drew, how's what Acquired is doing with that security token? How is that unique in the investment space, and how do you see it playing out? Right, like as far as the innovation in the space.
Yeah, well, so I guess the first piece is the We funder is through what's known as a Reg CF, so that's the crowdfunding regs that were kind of rolled out in the early 2010s, I think. And as Brian mentioned, it's kind of links into his platform service after the fact. On the security token side, this is really done via what's an exempt private offering, private placement. So this is the world of accredited investors. And again, this is kind of a well-worn path for private equity, venture capital, and otherwise. It's novel to me in that in the connection that he's building between the offering and other products and services that the platform can offer. But again, as I said at the start, there's really nothing new under the sun here when it comes to securities offerings. You either have to do it via a valid registration or you have to do it via a valid exemption. And for Brian, he's doing one from each column.
You also mentioned, Brian, that third component there, where you're going to launch it later, the NFT, right? The access card. And you mentioned the kind of the utility behind it and what it allows you to do. And you mentioned it's not a Bored Ape NFT. It's not a picture or an art. It's actually going to be useful for your platform. How can someone who's not technical, right, engage with the NFT? Is it something that's also going to maybe be on their platform, under their wallet, and so it's almost like we talked about this before. You're engaging with the technology without really knowing it. And I'm wondering if you could talk a little bit more about that, about being an NFT owner without having to have all this, knowledge.
Yeah, that's a great question. A lot of people are confused a lot of times when they enter or they start talking about or hearing NFTs. Memberships come to mind. This is sort of, in a way, a membership. It's a card that gives them access. It gives them perks and benefits, tangible benefits within our ecosystem. And it is transferable, right? So if I'm a member at a golf course or something, I choose to stop paying and leave that membership, I'm no longer a member at that golf course, and that golf course now has the ability to go and sell that again. But if I'm a member holding this access card, I can sell my membership to another person, right? Rather than, the entity, in this case, the golf club, selling it to that other person. So that's like one example. It gives the user ownership over that membership, and it gives them the ability to kind of reap potential rewards from it. For example, if there is some sort of whale that occurs in our app in the future, we hope that there's going to be a lot of those playing in and out of this market. They may see very meaningful, tangible benefit for getting 25% discount on their trading fees. And if you're an early shareholder holding this card, I would assume that would be very valuable to that other whale who's doing a lot more volume and likely to see a lot more benefit with a discount like that. Now, if you're not very technical, you don't have a digital wallet, but you've become a shareholder, when you actually build your account, right, we are going to see that you're a shareholder. It will show up in your account, and then the NFT access card will be claimable in your account as well. So we're taking a lot of the guesswork out of it for those types of users. And that's kind of our entire mentality. Building the app itself is to try to become something that's very simple, easy to use as a whole for the average investor, bringing more high-level assets to retail investors that have not had access to those before. We don't think that it's any different than what Robinhood did by just making accessible assets more accessible, right? Similar to the collectibles market. Everybody can do collectibles. They get the collectibles market, but then collectibles.com and Masterworks and Rally Road come and they build a secondary market around it, making it more liquid, easier to get in at different levels for different levels of investors. So if I'm a millionaire, I can go buy this fancy car, but if I'm not, I can't get the benefits of this fancy car, right? This Mercedes that appreciated in value from 100,000 to 8 million, right? Yeah. It's actually kind of nuts how those things happen.
Yeah.
But
it happens. Yeah. Especially in new markets, there's so much people exposed to these new markets. You use the word membership, and I kind of wanted to shift the conversation here a little bit. You talk to different platforms. I've talked to different platforms, and a lot of different companies are starting to use their NFT as a membership, right? And then the natural progression for that is a DAO, right? A decentralized autonomous organization. And that was a buzzword for, I would say, for a while. It's kind of settled down a little bit. And I mentioned DAOs because that was also kind of this gray area legally, right? And it really came to light when this group of guys were trying to buy a copy of the Constitution. I don't know if you guys remember that.
Yep.
And it went viral, right? And I mean, they raised something like 40. They had like something like $50-something million, but they could only bid up to 40 because of costs. And then news came out like how limited people were, how little they knew about exactly what their standing was in the DAO membership, what the token entitled them to, and so much. I want to have a conversation about DAOs. What is the current legal landscape there? How have they changed over the last, say, 6 months to a year?
So there is not a lot of regulatory clarity about DAOs, and this is a good example of where technology has facilitated capital formation and de facto entity creation that's sort of outside of the rails that have been established under current regulations. There's a handful of states, Tennessee most recently, that passed DAO LLC legislation. Wyoming was the first to do that. I think that there's principal risks associated with DAOs. Really depends on if its goal is to operate as an operating entity or if its goal is to be an investment entity. And then from there, you've sort of got to choose your own adventure of landmines that you need to avoid. But there are a lot of risks for people that are participating in DAOs without a limited liability shield. For example, if you've got a group of people operating together, then you probably have, from a legal standpoint, a de facto general partnership. So you could, in theory, be unlimitedly liable for any actions of anyone else in your DAO. That's just one risk, and haven't analyzed that scenario fully, but other concerns are, if you sold DAO interests, you can certainly do it without complying with securities laws, and that's a problem too. And then, finally, I think the third principal area of concern from a legal standpoint is, just simply regulatory compliance. If you do have a de facto partnership, do you need to be issuing, K1s to every member? Do they, what is the general governance of the entity or the organization? All of this stuff can be done on chain, but that doesn't make it, in the eyes of, legal entity status, it makes it much more complicated. So there's a lot there to unpack, and a lot of things that I think we've been thinking about internally at Frost Brown Todd. But at the end of the day, what I think is needed is structures and planning on the front end, because a lot of times people get into these and it's sort of like the dog that caught the car. The Constitution DAO is a great example. We raised all this money. It was super easy. Well, first of all, we failed to get the Constitution. But now what?
Yeah, I mean, he makes a great point. It's the same the same thing that happens in any emerging technology. It moves really fast. Developers, they love frictionless environments that they can develop in quickly. They can explore and try to innovate on current systems. But when they see the rules regulation, they start to slow down. And that's what's occurring now. They ran fast. They got some very exciting vehicles together. They showed its value. They showed that the technology could escalate, scale, increase reach, increase efficiencies across some of these metrics or some of these areas that used to just be done via a middle office, back office, legal, a lot of communications. Now you can do it through an app, right? More or less. It pointed to the fact that we have something. Drew now points to the fact that, okay, you've got something, but what do you do with it? You have to do it the right way. Otherwise you could get in trouble, right? There's a lot of ifs that occur, and technology can't account for every if, but we can identify where it can increase efficiency. And I think that's the stage that DAOs are in right now is, a lot of these guys that did spin up some really exciting vehicles and raised a ton of money for various purposes, whether it's an investment vehicle or otherwise, they now have to figure out how to manage not only the technology, not only the money, but the people. And people are pretty complicated. So
that's the hardest part.
Yeah, and I'm actually personally excited about it. We want to be tokenizing, DAOs, their ownership interests under, securities tokenization. So basically taking that rule set, guiding them into a compliant framework under the SEC or wherever else they need to be, and then bringing that to a larger user base, potential buyers or members of that LLC through the app itself, because it's really no different than being a member of a venture capital group, for example, being a member of a fund, or in many cases this is just an LLC that has a bunch of working owners or non-working members. They're just participants or owners of the LLC, but not actually operating it, right? So some of those vehicles, some of the DAOs, not all DAOs, we are pretty excited about. We just want to see some of those groups move towards the compliant, way of doing it, and then hopefully we'll be able to offer those to our users as well.
How is being a DAO member or a DAO founder different in Tennessee than it is with that crypto bill than it is in any other part of the country, Wyoming as well?
Yeah, so to me, the big change with the DAO LLC legislation is that the management of the entity can be delegated to a smart contract algorithm. So in this case, you can have programmatically governed entities, which you could, in theory, push off to a DAO membership that is separate and apart from the ownership of the entity itself. So this could be a scenario where the company itself has delegated its authority, its management authority outside of the entity, where you could have governance, people providing governance via a governance token that would be separate from the ownership and the assets of the LLC. The question I've had with that structure is, why would anyone want to participate in an LLC governance activity without the benefits of ownership, right? So there's surprisingly a number of DAOs that operate in that fashion, where the governance token is the baseline utility token that kind of juices the entire network, but whether it's a foundation that ultimately owns the DAO or even private companies, those individuals are not participating in the profits of the enterprise. Right. So the Tennessee statute takes a step towards recognizing that framework as legal, which is a big step. Again, because I think a chief concern of a DAO formation is lack of limited liability for the participants.
How about for people that want to partake in the profit?
Yeah, well, I think we're still stuck, as Brian mentioned, with fitting into an existing regulatory framework. So I think Reg A Plus, for example, has probably a promising path to be able to issue DAO ownership interests a little more broadly than is currently available. But again, all these things take time and money, and so that's the challenge. And there isn't, it's stupid easy to pull together a bunch of money in a DAO without doing it the right way. It's a lot harder and more expensive to do it in a compliant way. So that's where builders need to start taking it up and kind of taking it to the next step. I can definitely foresee one-stop shops on DAO formation. Right now, there's a lot of technology tools that are around DAOs, but not a lot about compliant DAO organizing. And so to me, those are the kind of the steps that need to be taken in the builder community to get us where we need to be.
Yeah, I mean, like we talked about earlier, it's just builders want to move fast. They want to take advantage of a wave. When crypto's flying high, people are looking for things to get into, and the thing that prevents you from moving fast is having to spin up, a foundation and another entity and this LLC and filing it properly with the state, with the federal government, and then all of a sudden you're in $10,000, $20,000, $30,000 in legal bills, and you haven't been able to raise that money yet, and it's probably pushed off your launch date by a month or two. And then the developers sit there and go, well, I'm just going to raise the money first, and then I'll, ask for forgiveness later. And that might work for a large portion of people, but some people will probably get caught in the trap of enforcement somewhere along the lines. Yeah. And I think we're starting to see that occur, just like we're seeing that occur across the cryptocurrency space. And I'm a big proponent of cryptocurrency across the board, Bitcoin and so on and so forth. But we're watching the Ripple case go down and what's happening with the SEC. You watch it happen on individual enforcement actions, whether, even the non-fraudulent ones. There's tons of out there that are just fraudulent. And just be smart, do your research before you jump into things. But the ones that aren't fraudulent are still going through enforcement actions, because they moved fast, right? And it's an exciting place to move fast. That's how innovation occurs. So it was really exciting to see the president, say something along the lines of, we want to foster innovation, but we have a call for clarity now as an executive order. What's happening? And then all of a sudden the SEC hires 50 more people. We have this stablecoin push for 2022. I think by the end of 23, we're going to have more clarity than we've ever seen in the space. And that means clarity means adoption at an institutional level. When you look at what we've built so far, it's a $2 trillion market cap in the crypto space, plus or minus depending on the movements of the day. But, when you look at overall finance, it's $500+ trillion in just markets. We're dwarfed by the potential that blockchain has to revolutionize different levels of finance in general. So, we're excited to see how that moves, and that the president, the regulators, and everybody's pushing this direction. We just want them to do it in a responsible way, to foster these vehicles and give them the opportunity to flourish. For us to innovate and become a little bit more efficient, right? Less waste is the goal.
My last question, and I want to thank you guys for taking the time. And it's more of a kind of like a broad question is, can a decentralized, finance, space truly flourish, right? If there's such thing as an overregulation, or if Congress is stepping in with a bunch of laws, or is that not the case at all? When we talk about regulation, are we simply talking about having some guardrails to work with? I want to have your take on that.
Yeah, I think if they'd wanted to kill it, well, first of all, the horse is out of the barn, so it's too late. But they could take steps that they have not taken to dramatically curtail development of this space. And so my general broad view is that They're going after bad actors. That's where the priorities are. In particular, the SEC speaks louder than most regulators, but there's a crowd of other regulators that arguably have, probably a better stake to the territory than the SEC. The CFTC being one of them, which is a lot quieter and a lot more observant of what's going on. But again, I think we all, as practitioners in the space are, obviously watching all this very closely, but the point is to, to work within the frameworks that we have. And as they develop, we obviously want to input on that process, and a conversation is important. And I've seen that willingness so far, and I expect it to continue because, again, it's far too late to unring the bell of crypto, blockchain, and everything else. And the last thing the regulators want to do is scare everyone so that they leave the United States.
Yeah, like we've historically been a country of innovation. It's provided us a lot of opportunity and a lot of growth and a lot of wealth creation. And I don't think that, the regulators are in a hurry to change that. I think they want to foster that. And it's just about investor protections. They just have to move, in a good pace, but in a way that allows us to communicate with them. They always say, hey, come, companies like Acquire and others, come talk to us. Tell us what you're doing. Tell us, what the issues are with our current regulation. How can we improve? And they want to also have a say in how we do business. They want to say, look, what you're trying to do may or may not be good for these reasons. We've experienced this historically with, markets or with certain investors having issues or being taken advantage of, certain demographics of people. So ultimately, I think it's a collaborative process. We're at this kind of tipping point. Like I said, I think by the end of 23, we're looking at some big moves that are already underway. And I don't think anybody's going to stifle the innovation. But the question is, how much will they foster it?
So much to think about heading into the rest of the year. It'll be really interesting to see how the markets play out after this crazy beginning to 2022. Well, not really beginning, the middle of 2022. Thanks so much again, guys. Drew, thanks for being on the podcast. Brian, thanks for coming on again. Really, I think there's a little bit more clarity, right? When we're talking about what you guys are building and how it's different, right? You're innovating, but it's not the same kind of innovation as you mentioned, with the Bitcoin, the stable coins. And it's such a wide world out there, and people need to understand the differences. So thank you again for guys coming on.
Yeah, thank you, man.
Yeah, absolutely, guys. Have a good one. Take care.
Cheers.
This was a great discussion about blockchain and why it carries advantages over traditional methods. Brian really lays out how he is using blockchain to make for a better run investment platform. Andrew's legal insight into cryptocurrency, blockchain, and DAOs are proving invaluable as Brian is set to grow and launch Acquire. Many thanks to Brian and Drew for joining me on the podcast. Always great to talk alternative investments, plus the blockchain, plus regulatory stuff. And a big thanks to you for spending part of your day with us. If you enjoyed today's episode, let others know about it or leave a review or a comment. Until the next time, take care.